Welcome everybody for the next hour and a bit for this discussion around the, as the title says of the presentation, analysis and valuation of digital business. As Brendan already mentioned, it's a topic that is quite important today. I think over the last couple of years, also in my daily work, the number of businesses that are related to or involved in digital innovation to reduce costs, to increase revenues, or actually to transform entire industries, that number of situations has exploded. It's a fascinating topic. And actually, in the latest edition of the book Valuation that you can see here on the slide, we also therefore dedicated a separate chapter to the analysis and valuation, specific issues around that for digital business models. I'm not going to give you a very precise definition of what digital business is. It's a bit of a fuzzy concept, right? For some people, it means improved and automated warehouse management. For others, it means redefining an entire industry, like in ticketing and booking, for example, or in fintech. We could talk half a day just around what really digital business is. We'll have a fairly practical and wide definition that it involves all these initiatives, all these activities in business that are essentially based on digital technology. As I said, it's a separate chapter in the book nowadays, not so much because the fundamental approach to the financial analysis and valuation of these businesses is different. In fact, we will argue it's still based on the same fundamental economics, but because there are a couple of facts, figures, and approaches that make the analysis and valuation of digital businesses different and actually more challenging or interesting, whatever you like. What I'll try to do over the next hour or so is give you a bit of a flavor of the diversity of business types that we'll encounter. Let's call it the fundamentals of making a proper analysis and valuation of digital businesses, and some examples of steps that you should take into consideration when you actually embark on the valuation of a digital business. I think the first message, and maybe it's the most important message, is that also for digital businesses, right, the same fundamental principles of value creation hold as for, let's call it, traditional businesses, which means that in the end, we know value is actually driven by cash flows, although for some digital startups, right, these cash flows may be very far away. Still, digital startup businesses have a value today because investors and entrepreneurs expect these businesses to start generating cash flows at some point in the future. So value still follows from cash flow. Cash flow, as we show extensively in the book, are still driven by growth and return on capital. And of course, there's cost of capital that also comes into play when thinking about value and value creation. These fundamental principles, they hold for digital business as well as traditional businesses. It is just that the way we deploy these concepts like return on capital and growth, or to some extent even cash flow, that the way we deploy them may be a bit more challenging, a bit more difficult when we think about some forms of digital business. Now, one of these characteristics of most digital businesses, right, that makes analysis and valuation more complex is that in many cases, there is phenomenal growth in these businesses. And here is just one illustration. There are many ways to actually show this. This is for a set of listed, stock exchange listed digital startups, showing the growth, from the year after they reached the first 10 million in revenue. So let's say some sizable scale, and what is the subsequent growth in the first 5 or 6 years after reaching that 10 million revenue threshold. And we can see that even for the median, that growth rate is around 70%, right? Phenomenal growth percentages, and even for the lowest quartile, right? The lowest quartile growth among these digital listed startups is around 40%. So very high growth, which means that not just revenues, but also costs, margins will change enormously from year to year, or in some businesses even from quarter to quarter. And that makes the analysis and the valuation a bit like, observing very much like observing a moving target. The second thing is what we find is that digital businesses often show very different economics than traditional models, and different economics in the sense of different margins, different capital turnovers, different returns on capital. And that has a lot to do, we'll get a bit into that later, with the fact that many of these digital businesses are very easily scalable. Here's just an example. It's loosely based on the chapter that we show in the book on valuing high growth companies, where we have the case example of Farfetch, right, which has a multi-channel retail model. A bit loosely based on that, where we can see that for the different business units within even the same company, the digital-based business models, the marketplace, right, where essentially it's an online platform, plus the e-commerce, so the online retail platform, has significantly higher margins, right, than the traditional physical stores. And that the same holds for the capital turnover, much higher in the digitally supported businesses than in the physical store business. So we see very high growth, and in some cases also very different economics in terms of margin and turnover. And that means that these digital businesses, actually require a more thoughtful approach in the analysis and valuation than most of the traditional businesses that essentially were there when I started looking into analysis and valuation, right? Where you had single-digit growth, fairly stable margins, and actually the business 5 years from now will be still pretty similar to the business today. That, for many of these digital businesses, because they're still often in early stages of the life cycle, is a very different story. And what we find is helpful is to, before diving into the finance content and thinking about where the value creation is, what the value could be, is to also spend a bit of time about thinking of ways to group all these digital businesses, these digital initiatives, digital programs. And at the highest level, as we discussed in the book, we kind of split it into two. One group of digital businesses are these what we call disruptive business models. So these are essentially new services, new products, or new delivery systems, production systems that fundamentally transform actually almost the entire sector. The examples are eBay, which fundamentally transformed the whole sector of buying and selling, not just for private but also for business units. Uber, which has transformed the mobility sector, Booking for the hotel reservation and ticketing. Same for Facebook, which actually came up with a service in social media that didn't exist before. We'll talk about that a bit later. For many of the incumbent companies, actually digital business essentially often means doing existing things better, which could be using digital technology to reduce costs, to improve the customer experience. We'll have a couple of examples later on, to create additional revenue sources, or to just improve decision making because there is better information and there are better algorithms to get to decisions on pricing, yield management, etc. Having said that, both groups of digital businesses still follow these fundamentals of value creation driven by growth and return on capital. With a very important caveat from what we've seen over the past couple of years is that although many practitioners follow that road, we shouldn't really think too quickly about applying a higher cost of capital for digital businesses, not for the digital businesses that help companies, making their current business system better, like in the second group, nor for even the new disruptive business models where some people would argue it's high risk, so you need to have a higher cost of capital. We'll get to that a bit later. What by default we essentially say is don't apply a higher cost of capital when you do evaluation of digital business. Use scenarios to put the risk and the uncertainty in the cash flows rather than in the discount rate. So two groups of digital businesses at the highest level, and one important caveat when you think about analysis and valuation, don't jump to changing the cost of capital. Now, within these two groups, there are lots of sub forms, lots of specific ways that companies could deploy these digital activities. And we could actually spend a whole day on discussing different ways, even on the second category of helping to improve the performance of existing business. So this group is not about defining a new business, a new sector, or transforming a sector. This is essentially all the ways, and there are many of them, where we just have a couple of examples that existing companies, enterprises can use digital technology to, for example, reduce costs by predictive maintenance, especially in heavy engineering, heavy equipment industries, or robotic process automation, right, where actually you can improve the speed and reduce the cost of many administrative tasks. It could be by improving the customer experience, which could be the online financial services that many banks have already been offering over the past couple of years, but of course also mobile banking services, where essentially we can all transfer money, invest money, and manage our savings on an app or on our telephone, or the one-click purchase that many of the online retailers have introduced, which essentially don't change the way a bank conducts its business, the way the retailer conducts its business. It just improves your and mine customer experience. And let's be honest, right, that's something that's not over the past couple of years. Banks have started with maybe mobile apps over the past couple of years, right? But the introduction of online banking services started, probably something like 15 or 20 years ago. And automated teller machines, where you can actually get the cash out of the wall, as we would call it in Dutch. That's something that started already in the 90s. Same for the airline industry with automatic ticketing services, etc. Third, it could be essentially generating new sources of revenues on top of the services and the products that a company is already offering. And that could be the example of that we also show in the book of John Deere, already a market leader in for example, agricultural equipment. But John Deere also discovered that by adding digital capabilities to their equipment, they could actually introduce soil sensors. They could introduce meteorological information to actually help farmers optimize the deployment of the John Deere traditional hardware equipment. And it actually has become a new source of revenue for John Deere, because with subscription you can actually qualify for different levels of additional data, additional analyses. And last but not least, right, digital technology can also help existing companies to improve their decision making, and that could take many different forms. But one of them would, for example, be what in the airline industry has been happening over the past couple of years. Very much improved yield management, so much improved pricing of individual seats on each flight, where actually depending on the number of days or hours to departure, the areas from where actually the customer is flying from, you can find ways with digital technology to optimize the pricing level for each individual seat. So lots of ways that digital technology, even in a traditional way, essentially improves the way that current businesses are performing. One special thing to keep in mind there is to make sure that whenever you're thinking of analyzing and valuing the potential benefits of these ways that digital can help improve your business, is to make sure you have the right, let's call it, base case. So depending on what business you're talking about, and especially what your competitors might do, right? The value of such a digital initiative, for example, to improve the customer experience, should be interpreted with care. So, for example, if we go again to the banking industry, where banks have been introducing new ways of interacting with their customers over the past 2 decades, right? And only in the last couple of years, it has also taken the form of mobile applications on your phone to manage and transfer money. Here the thing is that depending on what the competition does, right, the initiative to improve your customer service may still have a positive net present value for the initiative itself. Introducing mobile apps will lead to more sticky customers, will actually bring benefits to the bank. It may in the end actually not increase the value of the bank. And that's because the base case, as we say here on the top, is not business as usual. So if the bank doesn't adopt mobile applications, it's not as if the revenues or the results will continue at the, let's call it here, the 100 level, as you can see in the chart. But actually, if the bank doesn't adopt digital technology, improve the customer service, competitors probably will do. And you end up in the lower half of this chart, where actually the base case is going to be business deterioration. And what the digital initiative will do to improve the customer experience is actually create a positive MPV that will actually lift the value of the bank back to where it was. So it's almost like a value protection form of thinking about this. And I need to shift my own video screen here. The way to think about this is not always to think that this is positive MPV and therefore it will increase the value of my business. In many cases, actually, and the same holds for airlines, in the way they've made it easier for all us passengers to buy and use our tickets, going from paper tickets to electronic tickets to actually mobile ticket applications. It's not as much to improve the value of the airline, improve the value of the bank, but actually to preserve the value. And the MPV of the individual initiative is still positive, but it's actually a protection against value deterioration. Right? The same for industries with heavy and expensive equipment, which could also be airlines on predictive maintenance for aircraft, right? Where, yes, you can identify annual cost savings if you deploy predictive maintenance. The MPV, however, if competitors follow and reduce prices, is probably zero in the sense that the value of the company won't change. But the unfortunate thing is if you don't go along with this new trend, actually your value will come down. And that means that the net MPV of reducing your cost through digital technology is still positive. It's just not going to show up in your share price. That's the big thing. So that is the key takeaway for doing things better with digital technology. Now, the other group of let's call it digital technology deployed in businesses is where actually you define a new business model, which could be an entire new sector. It could be a very fundamentally different way of doing business in the same sector. And these are the more spectacular examples, of course. And these are the examples that we all love to talk about, whether it's Uber, WeWorks, Amazon, etc., etc. Now, here the thing is that what makes the digital business model special in many cases is, as I mentioned in the beginning, is the very high growth and in many or some cases very different economics. In some cases, we come across practitioners, investors, entrepreneurs who think of their digital business model, this disruptive digital business model, as a winner-takes-all model. And a winner-takes-all model is a very attractive concept, right? Because essentially it suggests that the company that actually is successful in taking the market, let's defer a bit on what the market is. The company that essentially is the first to reach a certain size in the market will actually take the entire market and create enormous amounts of value. So this winner-takes-all has this magic feeling to it. And we're not saying that winner-takes-all doesn't exist. It does exist. We do think, as we say in the book, that it's still very rare. And that winner-takes-all as a label on a digital startup or an early stage digital business is still in many cases kind of misused, because there are a couple of conditions that will define or will determine, I should say, whether a business is going to be a real winner-takes-all, right? And we should be very clear about what these conditions are, because that helps us in distinguishing between the phenomenal growth, phenomenal value digital models and what could also be reasonable but not the most spectacular businesses of the future. The traditional thinking, and that goes back to a very long history in economics, right? Is if we think about the economics of a business when it grows, right? When, let's call it the number of users or the number of produced units, the number of services rendered. Let's just put it on the horizontal axis as the number of users of a product or a service. When that increases, that a couple of things might happen. The first thing that might happen, and will often happen in digital business, but not even all of them, is that the cost per user will start to decrease as the number of users increases, right? And that will happen for most of the e-commerce, most of the fintech, etc. Business models, which we know from traditional economics as well, right? In traditional production models. What makes it special in digital technology is that in some cases, actually also the benefits, the value of the product or the service increases, right, for each user as the number of users starts to increase, right? And the classical example that we also mentioned in the book is the telefax machine, right? As digital technology, or it was in the beginning, I think, even analog, but as a technological innovation of the 80s. You know, one fax machine is not useful, two becomes a little bit useful, it becomes really useful when lots of companies and people deploy a fax machine. That same holds for digital businesses. And then you get a very powerful business model that actually enables you to charge higher prices because there's higher value for each user as you grow, and that at the same time implies that the cost to deliver that service or product to your customer decreases as the number of customers of users grows. So this is what we see typically in business models that Uber deploys, or Expedia in ticketing and booking deploys, that as more and more people are involved in the business model, more drivers, more customers in Uber, there will be more cars in the street, it will be easier to find an Uber. It's more attractive to be on the Uber platform for both the customer and the driver. Same for Expedia with hotels and house owners versus customers. Very powerful machine economically, let's call it. So that actually is not entirely all it takes to be a real winner-takes-all model, right? You need a third condition to be a real winner-takes-all business, and that's that there must be a sufficient barrier to competition, right? There must be a way that you can preserve this condition number 1 and 2 for yourself, for your own business. And that could involve things like contractual agreements that prevent hotel owners or restaurant owners to switch to a different platform, which makes it more difficult in the case of Uber, right? Because it's hard to dictate that drivers will not be allowed to also drive for other passengers on different platforms. It could be contractual agreements. It could be switching costs, right? That like for most of us here on the line today, it is just very cumbersome to switch from Microsoft Excel to a different spreadsheet because the compatibility of the files would create all kinds of difficulties, because we would have to learn new macros or new formulas. We would need to get used to a new interface. So there's switching costs, which can also be very powerful barriers to entry. But it's especially if you have this third condition that you get this winner-takes-all business model, right? And as we argue in the book, that is quite rare. And the cases where this really applies and has demonstrated in the past are the cases that we all familiar with, right? That's why Facebook is at such a phenomenal value. That's why Microsoft is at such phenomenal value, because they have both found a way to create a particular barrier that makes it undesirable or costly or cumbersome for customers to switch to different providers, right? And in Facebook, you have to rearrange all your files, transfer all the data. People need to find you somewhere. So there's this subtle third condition that really defines this winner takes all, which is what most of the digital startups that I've come across, they all aspire to be, right? So let's be careful when you think about spectacular valuation of digital startups, that it's actually not that straightforward, right? It takes these three conditions to be this phenomenal success. And mind you, right, even if you don't have condition 3, right, just conditions 1 and 2 can still, if you just look at the names of the companies there, create these very, very successful and value-creating businesses. But still a different level than the true winner-takes-all business models. And that brings me to the next thing, that within these disruptive business models, right? Let's be careful. Let's not jump too easily to this winner takes all. Applies to every kind of digital business model that we come across when we talk disruptive models. The second thing is that there's a huge variety. And again, we could talk a whole day, and there are people who know much more about this than I do, about all the different flavors and types of let's call it disruptive businesses that are around. This is just to give you a bit of flavor of the regions there. There could be different groupings, but just in digital business model, it could be something in fintech, where we have some really established players from very long time ago, PayPal to Adyen, go along to the social platforms. E-commerce, right, where we have, there's also a Dutch one there, bol.com, to the marketplaces like eBay and Uber, to media and content service providers like Netflix, all the way to, let's say, software as a subscription, cloud computing services or storage services. I won't go into detail here, but from an evaluation perspective, such a grouping is also important, because the way these companies create value, the room for additional growth, the margins that ultimately might be reasonable that they would be able to attain, will be different across all these categories. And we also see that in the data, in terms of the growth rates, the margin improvements, that there is there are some systematic differences between these groups of, let's call it, subsectors. So understanding where the company that you're doing the analysis valuation of, in what type of digital business it actually is in, is quite important when you start. Another element, and that's related to the winner takes all, is to, whenever you think about digital business valuation, especially early stage, where valuations we see going up over 1, 2, 3, 4 billions and more, even for businesses that are fairly early stage, is to still keep in mind and keep some perspective, put these estimates of value into context, right? Without doing a very in-depth discounted cash flow analysis with a big model, but to actually keep in mind, what it requires to get to a certain valuation level. And here's just a very simple example, right? To put it a bit into perspective, right? Let's say there's an early stage digital startup, right, that is valued today at 10 billion. Let's aim high. Now, what does that actually imply? It implies that, let's say, in 10 years from now, when this startup should be a mature business at some point, right? At some point, all these double-digit growth levels need to kind of come down to much lower growth levels, like we see in traditional business. So let's say in 10 years, 10 billion today, if you compound that at the cost of capital of 10%, 10 billion today would mean that this business, if it is truly worth 10 billion today, should be worth something like 25 billion 10 years from now. 25 billion. Now, let's also assume that if it's a mature business, right, it's going to be valued at that point at a healthy enterprise value multiple of maybe 12.5 times enterprise value to EBIT. It means that the operating profit, the EBIT, in 10 years from now should be something around $2 billion, right? Which is a sizable, right? That's a very significant company with a very significant operating profit. And to illustrate further, if you would assume there's a 20% EBIT profit margin, which is a very healthy margin that not many companies actually attain, we're talking about a company that should be generating 10 billion in revenues 10 years from now. And these are hurdles: the 10 billion of profit, the 10 billion, 2 billion of profit, 10 billion of revenue, that not many companies actually achieve. So keep in mind that whenever we're talking about these huge valuation numbers for early stage digital business, that that value needs to come from cash flows and profits and revenue somewhere in the future. And keep in mind that whenever you think about high numbers today, what is actually the underlying, the implied range for revenue and operating profit that actually this business should be generating then 10 years from now when it's in a mature stage? And is that reasonable given the products and the services it's going to aspire to produce and the markets that it's aiming for? So keep that a bit in mind. And before we go into a bit more depth on why to use DCF, is especially be careful with using enterprise value multiples, especially on EBIT or on revenues, because they tend to be all over the place. Even for the larger of the companies that I showed on this chart in different groups and subgroups of digital business, you can see multiples even for 50% of the companies in these categories are still negative. And that doesn't mean that their value is wrong. It just means that currently their EBIT is still negative or very small. And it just shows that because these companies are still experiencing such enormous growth, because their margins are still not at the mature stage, it becomes very challenging to use enterprise value multiples to actually get a valuation result, right? And it has to do with the fact that actually the basis for the multiple is hard to establish, right? The EBIT, but even the revenues for some of these companies change significantly from quarter to quarter, let alone year to year. So getting a valuation result with multiples, also with alternative multiples, not on EBIT, but maybe on customers served or on unique site visits, etc., very hazardous. And what we think actually the only way to get a reasonable estimate about the value potential of these early stage digital businesses, especially these disruptive business models, right? This category 1 that we were talking about. Actually, there's no other way but to do a discounted cash flow valuation. The discounted cash flow valuation, in a sense, it follows the same techniques that you would deploy for established consumer goods companies or established retailers. It still relies on the same fundamentals. But there are a couple of things that we find are helpful to include when you do this DCF valuation. And by the way, as I mentioned, multiples are a very shaky basis for doing evaluation for most of these businesses. DCF, we think, is probably the best way to go ahead. And having said that, what we also say is more complex approaches, whether it's with real option valuation or simulation, is probably a step too far, in the sense that all the data that you are going to put into the model, into the valuation, is probably in such ranges of uncertainty that using very refined and sophisticated valuation approaches is probably also not the way to go. It's somewhere in the middle, and that's what we think with discounted cash flow in combination with scenarios. Now, a couple of pointers in doing that DCF valuation well. The first being the most important is to start from the future, right? I'll explain a bit later, but the way to do a DCF is not on an incremental basis as you would do for a mature company, where you take the last couple of years, you look at what the revenue and the revenue growth and the margins here, and you start to maybe do some form of extrapolation with some incremental changes. Here, it's the other way. You need to start in the future. Start 10 years, maybe, or 5 years from now, when you think this digital business has become a more mature business, right? Where the online retailer has become a full-scale retailer with an online channel, of course, right? The second thing is to really ensure that you identify the underlying value drivers. So what actually are the elements that are critical for success in this business? What are the things that will make or break the value of this business? Is it market share? Is it the price positioning? Is it the efficiency in how they will be growing? Is it conversion of visitors to a certain site, conversion to paying customers, etc.? Be very specific about the underlying value drivers. Third is, whenever it's possible, right, is to analyze the early business cohorts. So think of and try to figure out for these fast-growing businesses, how well are the customers that first joined their service, that first acquired their products, how sticky are they with the business model? So how much is, for example, a company like Uber, how much is it making in the markets where it started with its services, where it's probably the largest provider of mobile services? Because that will give you an early indication of what you might expect for the later business cohorts, right? Where Uber is still growing and maybe not the largest in the pack. So analyze the early business cohorts. 4 is to develop alternative scenarios, because there's a lot of uncertainty for these businesses. How much volume will they attain? What will the margins be? There's no point in making a single estimate, a single projection of financials for the future. You need to be using alternative scenarios to get a sense and to chart out what this business could end up with. Because for many of these businesses, as I said, uncertainty is still very high, not just on the volumes, but also on the margins. Use scenarios to actually describe the different futures, and then probability weight these scenarios into a DCF, rather than using a high discount. And the 5th guidance is to also keep in mind that there is an inherent volatility in the valuation outcome, right? We see for some of the listed companies in digital technology, right? We see very, very volatile share prices. That is not necessarily because investors are irrational or stock markets are emotional. There is a fundamental necessity, almost, you could call it, for these share prices to be so very volatile. And that has a lot to do with the fact that small changes in critical assumptions may have a very large impact on the value that comes out. Now, let me maybe take a couple of these to show you a bit of the thinking around it. It's the first one, the first principle where he said start from the future is probably the most important and the most distinguishing fact in valuing digital versus traditional businesses. It's really need to start from the future. All these businesses will be aspiring to provide services or products to a certain market, a pool of customers, where essentially they will try to, or at least aspire to make a margin on selling and providing these services and products. And what is very important is that you cannot value these businesses by starting from where they are today and then making incremental making assumptions on incremental growth and changing market. Jump 10 years into the future and put a stick in the sand, as we would say, on what would this business look like, or should it look like 10 years from now if it's really successful following his business plan, right? What is the total market that this business is aiming for? Right, so what is the total revenue pool that they're fishing in, and what does it imply for ongoing growth? What would be the margins, the capital intensity, and the return on capital that this business could realize, right? Depending on how much actually could you sell to individual customers in the revenue pool? What could actually be the margin you could make per customer, to get some sense on what would be reasonable margins and returns on capital for this business when and if and when it actually reaches maturity. As an example, if you're talking about online retail, you could question why an online retail business 10 years from now, if and when it's successful, why the margins would be much higher, or even much higher than the retail margins for traditional retail today, right? There are cost advantages, but there's also going to be competition. But to think through, based on what the underlying business model is, what could be reasonable margins and return on capital for the business that this startup is aiming for 10 years from now. And from there to actually work backwards, right? To start 10 years from now, make some bold assumptions on total pool that we're aiming for, the share that we can capture of that pool, the margins we could make on individual sales within that pool, and what does that add up to the return on capital ultimately in 10 years from now? What would be the ongoing growth, right? And then from that 10 years from now, work backward to today to understand what is actually the expenses we need to incur to actually invest in, if there is a need for physical assets, or what are the expenses we need to make to invest for growth, customer acquisition, and developing technology. Right, so it starts in the future, from really understanding the business model and the underlying economics that the startup is aiming for, and to then work backwards from that 10 years from now to today. And that's a very different approach from the way you would set up analysis valuation for a mature in an established business. Right, and that means really understanding what this business is about. In the early edition, the 6th edition of the valuation book, we had this case example of Yelp, right? And we actually illustrated there how to use this thinking to get your hands around what the value of Yelp could be. Now, this is already now based on a 5-year-old example, but still, it's an interesting illustration of what this approach means. Right? It starts with understanding what Yelp is, and just for this afternoon, it's a bit of an online version of what we used to call the yellow pages, right? Or in Dutch, the gouden gids, where actually local businesses as opposed to international, but local businesses could use it for advertising, where customers could also leave reviews, and where actually Yelp would try to convert some of these local businesses into paid advertisers, right? So it starts with thinking about what Yelp could look like when it reaches maturity, is what is the total addressable market, right? What is the pool that actually Yelp, a company like Yelp, is fishing in? And that's essentially the question of how many medium and small-sized businesses are in Yelp's target markets, right? Whether it's the US or international markets. And then you could see, as we said in 2015, even if you think the total pool is the total number of local, small, medium-sized businesses, in Yelp's target market, right? 67 million of these businesses, and actually Yelp has captured on the Yelp side in 2015, just 1.5 or 2.2% of them, and actually converted only 0.1% of all these small and medium-sized businesses to advertising on Yelp. So that says that actually the pool is huge, right? There's a lot of upside potential. But to also understand, so how do you actually cover these businesses, right? How do you get them on your online website? And how do you register them and ultimately convert them into paying customers, right? It's great to have a lot of businesses on your site, but in the end, you will only make money if these businesses convert to paying customers. And then it becomes important to realize that essentially it's still an advertising model, right? And that you can think of the size of the market by understanding what is actually the size of, let's say, in the US alone, of the local advertising market, because this is not aiming for advertising budgets of the large international companies, the Procter & Gamble's, the Nestle's, and the Kraft. Yelp, in its business model, is aiming for the advertising budgets, effectively, of small and medium-sized businesses. And there you can make estimates, right? And you can see that pool actually doesn't grow that much, and it puts a bit of a ceiling on what could be the total market. The total addressable market that Yelp is aiming at, right? Now, how much percent of that total addressable market could Yelp capture? And what are actually the margins you could reasonably make, even if you are successful in capturing that market? That's actually how you do this whole thinking of starting in the future, 10 years from now, what is the total addressable market? What is the share of that market you could capture? And what could be the margins you make on that share of the market that actually you can attract to yourself? And this is actually the way you could think of a lot of, in this case, consumer-focused businesses, right? It's going into the future and stepping back. Second thing is identify the underlying value drivers. And actually in this whole thinking about Yelp, some of these value drivers already came through. It's making a very, very good logic of how do you create value in a local advertising business model, right? And it helpful are things like what we call, as we show here on this page, this kind of a value driver tree, right? Where if you just want to get a sense on the far left of what could be the local advertising revenues for Yelp, it has to do something with the number of advertising accounts, number of businesses you actually have converted into paying for advertising, and a combination with the average revenue per account, right? So how much of the what's the average advertising spend per business? What of that is online, and what share can Yelp capture to it at the bottom? So there's some combination of revenue per user and number of user to generalize it. And the number of users will depend on how many business locations are on the Yelp website, right? It depends on how many businesses will register, so essentially say that they are the business that is shown there. Depends on the population covered, et cetera, number of businesses per population member. And of course, the conversion ratio. And if you think through, we describe it a bit more in the book on how this business model works, you start to recognize there are actually two critical value drivers, right? The one is the conversion ratio. It is not that hard to get a lot of business entries on your website and to get a lot of reviews from customers. The key thing is how many of these entries on your website can you actually convert into paying customers, right? Advertising accounts. And that's the conversion ratio. And that's something you would like to track over time if you are investing or managing a business like this. And this is one of the key assumptions that will make or break the value of that business at maturity. And the other one is the average revenue per account. Just like in telecom, it's a bit like ARPU, right? The average revenue for each of the advertisers. Well, what is the maximum spend, or what's the average spend? You can extract from each advertising account from each customer, and that you can relate to how much percent of the total advertising budget of an individual company could you reasonably claim. And that gives you, in this kind of logic, a first indication of what are here the critical value. And there will be these value drivers different by business. While understanding them actually helps to focus the way you think about the future. It also helps to analyze the current performance as you get more and more information over the years for a company like this when you start tracking. The third is actually, especially for the early stage businesses, is to analyze what we call the early cohorts. And that's essentially because these businesses are growing so fast and often also in different geographies, that the aggregate growth rate actually and the aggregate margin of all the business units that they have in different geographies or maybe even different customer groups is not that meaningful, because it's a strange mix of customers that have been probably with the business for many years with repeat sales or maybe long-term contracts, and very new customers. And it could be also a mix in different geographies. So if and where you can, especially if you're doing valuations inside out, is trying to derive some insights from thinking about these businesses like cohorts. And it has a lot to do, and the reason you need to do it, as I said, has a lot to do with this very high growth, which actually makes it difficult to use standard analytical indicators. So what we find in practice to be very helpful is to have these special metrics that are all still based on ROIC and growth, as we show here on the right, but are actually a bit more suitable to these businesses that show very high growth and have mixes of and because of their growth in the customer base, have a strange mix of customers that may have been around for many years and customers that are brand new. So first is to understand cohort performance, right, by product or market across what we call vintage years. So understand for, if you're in video streaming, for the customers that have been with you for 1, 2, 3, 4, 5 years now, what is the repeat rate or the attrition for each of these customer groups? What is the average spend per customer? And what is the margin for each of these customers? The second thing is to think about slightly adopted levels of earnings margin, what we would call run rate margins. So a lot of the margins, for a lot of these fast-growing companies, margins are low, not necessarily because the business is not generating cash, but actually because these companies are still investing huge amounts of money into advertising, marketing, and promotion to attract new customers and keep on growing. So when you think about analyzing the performance of such businesses, if and where you can, right, try to filter out the amounts of money that are being spent on, let's call it customer acquisition, right, so that you get a better read on what the run rate margin would be. So think of it as the margin that the company would be generating if it would stop growing today, because that gives you a better read on what the long-term, margin that this business can achieve could be. And the third thing is to think very, very carefully about, when you think about growth, right, about attrition rates as well, right? In a lot of analyses that I come across on these early stage digital businesses, a lot of emphasis on growth, and that's understandable because you want to reach scale, because scale brings additional benefits in terms of cost efficiency and this winner takes all thinking, higher value to customers. But when we analyze growth, we also need to be careful that growth is something you can always buy, right? You can spend more on advertising, more on discounts, more on promotions, and you can always get more customers. So what is probably even more important in early stages is understand what the customer attrition rate is. So how many of these customers are you losing every quarter instead of just adding customers and thinking about the net? So think about attrition, and that's how it combines, right? Think about attrition in addition to growth. Think about run rate margins instead of reported margins. And when you do that, think of where you can splitting up this business in cohorts, because we know especially in certain business models like e-commerce and social media, that the behavior and therefore the margin, the opportunity to create value can be very different for established and long-standing customers relative to new customers. And that's effectively what we also try to do for a business like Yelp. And here's not about the numbers and the information, but you can actually see how, when you want to set this up in a model, how to actually deploy this, where you can actually list the markets that, of course, Yelp started in the San Francisco Bay Area, and then in 2006, the 1 year after the first setup, they expanded, of course, to the highly populated areas, Boston, New York City, Seattle, etc. You can almost track over time which regions Yelp became active in, and if you also have some information on, let's call it the conversion ratios, the average revenue per user for especially the early cohorts, right? So the ones where by 2015 Yelp had already been active for 10 years. If you get a sense of what is the conversion ratio, what is the ARPU for those cohorts where Yelp has had 10 years of opportunity to establish, grow, and protect its business, what kind of profitability are they ending up with, and what kind of market share in these early cohorts, right? They're core markets. And you can think of doing something similar, if you like, for companies like Uber, WeWorks, the takeaways of this world, right? Very informative, not just for the analysis, right? What is the real performance of this company when I look at the individual cohorts, but also for the valuation, because the early cohorts might give you a better read on what the growth rates, the market shares, and the margins, or in this case, the conversion ratio and the ARPU for Yelp in the long term would be. So think of cohorts. The fourth is develop alternative scenarios. And here is something, yes, all these businesses typically have very high uncertainty, right? It's very difficult to predict what kind of revenues they will generate, what kind of margins, still hard to predict, especially 10 years out. Don't start necessarily, or rather not at all, right? Putting all that risk in terms of a premium on the discount rate, using a higher cost of capital, because this e-commerce company is a lot more riskier than a traditional retail company. We think that fundamentally that's a tricky role, because ultimately also the e-commerce company will be at some point a mature retail company, just with a online channel, you could argue. So the risk in the long term for companies like Bol.com are not going to be fundamentally different than the risks for a company like Albert Heijn, or business like Albert Heijn within the same AO group, as an example. And the same holds for Amazon in its retail operations versus other retailers. It still means that there is a lot of risk in the sense of what kind of revenues and margins will these businesses will be able to achieve when they are at maturity. And what we think is, to capture that uncertainty, the best approach is to use what we call a scenario-based DCF. So essentially where you make different scenarios into the future, right? Which for some of these companies might even be something like the business plan is successfully executed and achieved. And the alternative scenario, just one, is it will fail, right? So it's a bit of a binary choice almost. So put the risk and the uncertainty in the dispersion of these scenarios, right? Where you have an upside scenario here with a certain probability and a downside scenario. And then when you weight these scenarios with their respective probabilities, the cash flow, right, that results as the expectation value in each year, you discount at a regular WACC for that type of business, almost regardless of whether it's a digital business or not. And of course, the big trick is what is this probability, and that's something that, of course, nobody knows with a lot of accuracy, and that's where actually fundamentally the uncertainty will remain. Right, the uncertainty is there about whether this business will be successful, achieve its business plan in the future. It's captured in this probability, and that will be a huge component. and a huge driver of the value. There's nothing we can do about that, unfortunately. The alternative is what we do encounter in practice is that actually the only thing that's being discounted are the cash flows that result for the business plan, and to compensate for this high risk, because there is still this lottery effect that will they achieve their business plan or not, that risk is actually compiled into a premium, where essentially the WACC is increased by 5 or 10 percentage points to account for this additional risk. Now, mathematically, and we won't go through the numbers, but I trust you just believe me if I explain to you. Mathematically, you can come up with exactly the same number, of course, right? You could make a scenario DCF where, for example, here we have a probability 15% being successful, 85% of being not successful, and essentially being a very mediocre business generating 5 instead of 100 aspired cash flows per annum. You essentially weight them with the probabilities to get the true expected cash flow, which is actually what theory tells us to do, right? We should, when we discount at a WACC or a cost of capital, we should be discounting the expectation value of the cash flow, right? Not the business plan. So the pure theoretic approach is exactly this scenario approach, weighting the cash flows, getting the expected value of the cash flow, and discounting this at a regular WACC, right? For a regular retailer, a regular booking agent, etc. And you get a DCF in this case of 54. The alternative approach is to say we're not going to discount the probability-weighted expected value. No, we're going to discount the business plan cash flow. So just the top line here, right, with 100 going up to 103. And there you can see that you can get to exactly the same result if the adjusted WACC would be 32%. Which explains why, in venture capital, you come across these very high discount rate, right? Because if you want to discount the business plan cash flows, you need to get to a much higher cost of capital. And that cost of capital somehow should represent the risk of this business, 85% not achieving its business plan at all, but actually failing heroically or just being a very mediocre business. So both could lead mathematically to the same result. The unfortunate thing is that with an adjusted WACC, 32, 40, or 30 or 25%, very little guidance on where you should be. And you could argue the same is for whether it should be 15 or 85, but at least the 15 you could try and plausibilize by discussions with management, right? Also looking at the track record of other companies that have tried similar things in adjacent sectors or in the same sector. But be very careful with using these increased discount rates, because actually it also starts to make the analysis less transparent, right? If you're very explicit about what is the cash flow in the business plan, what is the probability of success, what's probability of failure in the corresponding cash flows, that's what you can have a discussion on, right? And that's also what we did for Yelp. And essentially, it means that you get, for, in that case, 3 scenarios. There are different probabilities for the different outcomes. And you weight the cash flows and the DCF results with these probabilities and get to a probability-weighted DCF. And again, where the risk is put into the cash flows, and you're very explicit about what the probability of failure and probability of success would be. The fifth, and actually naturally relates to the fourth element we just discussed, which also is highlighted when you do this scenario approach, is to be careful that when you talk about these type of businesses where the future could be, a fantastic success or a heroic failure, right? Almost binary. That it means almost mathematically there will be always a lot of volatility around the valuation we'll achieve. And this scenario approach very carefully, nicely illustrates that. So let's take a very simplified example, right, where you have a business that has a plan that could, if the plan is successful, generate a value of that business today of 500, right? And there's a downside scenario where actually this is an all or nothing business plan. If the business plan is not successful, it will fail completely, right? And the value will be 0. That the probability of success is 5%. So 1 in 20 of these businesses succeed and the other 19 fail. So probability of 95% of failure. It means the expected value, if you do this scenario approach, is just going to be 25, right? It's 5% times the 500. Now, very, very straightforward. What it also means, right, and this is very basic finance, basic mathematics, so nothing spectacular here, is if that probability changes from 5% to 7.5%, And I don't think anyone here can tell the difference between a 5% business plan success rate or a 7.5% success rate for a business plan. We wouldn't be able to distinguish the business plans, right? The very small shift in the probability of success from very small to very small, from 5 to 7.5%, would already mean, logically, right, that the value of this business would jump from 25 to 37.5. So 2.5% percentage point change in the probability of success would lead to a 50% change in the value of this start. And it all has to do with the fact that a lot of these businesses are binary almost, right? It's an all or nothing approach. We're going to have tremendous success, and if it's not a great success, typically it will just fail. And if you understand that, and if you recognize in your scenario approach, it's always also very straightforward to see that even small changes in these small probabilities, right, lead to very big changes in the value. And that's why it shouldn't be a surprise that we see for those companies that are listed on the stock exchange that are in this category of business, right, we see huge changes in the share price almost from day to day, because it's these invisible changes in probability that could have a dramatic effect logically, right, on the value of the business. And you can imagine if their investment outlays in the early years, right, you get the additional leverage in that value, and value will go up and down even more. So that means for digital business, right? And again, I tried to condense this all in an hour, and there's a lot more that as you can read or find on the topic. I think the key things to keep in mind when valuing these digital businesses, first, that the fundamental economics still apply. In the end, investors pay the money for these businesses because they expect high cash flows in the future, not because there's some kind of a mythical component in these businesses that translates into value today. In the end, it's still about cash flows. In the end, it's still about return on capital and growth. The only thing is, it's very far out. The second thing is to really spend time on identifying the key value drivers. Right? What will make or break this business? Right? What will make the margins high, margins low? What will make the market share high or low? And understand, right, what that is and how that translates also in indicators you can track from recent history in these businesses, and also going forward when you need to monitor the success of these businesses. Third thing is to really adopt a DCF valuation. Don't rely on multiples, and do it with scenarios rather than with a high cost of capital, because it forces you to think about what this business could be if successful, what the probabilities would be of success and failure. And finally, a couple of times already mentioned, right, start from the future. These are not businesses you will analyze and value on an incremental basis, starting with last year's annual report. I mean, that's still important to get a basis, but in the end, you need to start at maturity for these businesses and work your way back to today. That's it, I think, for me, Brendan.
I knew when I saw this presentation, oftentimes I attend a lot of webinars myself, and I find a lot of times you go to a webinar and it promises to deliver all this information and value and learning. And then when you go there, it's kind of underwhelming and disappointing. And I think that you've delivered something that is the exact opposite. I think that if you have even beyond a casual interest in doing the valuation of companies, especially in the digital space, I think some of the things that you shared is absolutely incredible, especially to do it in an hour. So from that perspective, I would like to thank you for sharing just kind of a tip of the iceberg in a way, because I know we're discussing about actually having eventually later this year a one-day course devoted to this, because we've had a lot of feedback and comments from people over the years who have done your business valuation course that you do with us as well. Really briefly, because we are over time and I want to be sensitive to everyone's time, yours included. But can you share briefly what kinds of things can someone expect to do if they were to sit in on a full day course specifically devoted to this topic? And again, briefly, you don't have to go in depth, but just some highlights would be great.
Yeah, and I think the areas where there is some interesting additional depth, right, to discuss is on one hand a bit more of the economic grouping of these different digital businesses, as I showed very briefly on the page, with all these categories from fintech to software as a service. to have a very careful grouping, and not as much on the technology, but related to it on the underlying economics, right? So how do you actually create value in fintech, right? What is a fast-growing fintech company? What kind of growth rates are we talking about? What could be reasonable, mature state margins, and what will make the margin higher or lower? Right? What's the level of competition you could expect? So at that level, I think that's a fascinating topic because there's high diversity of these businesses. There are some early track records that are developing now. So it gives a lot more discussion for where these businesses could actually end up. That part is actually almost, let's call it more strategic, right? And fundamental business than corporate finance or valuation. I think on the corporate finance and valuation components, there's a lot more around the different approaches, right? So I kind of discarded the valuation multiples as let's not go there. Obviously, you would still look at multiples, but more to triangulate your results. But thinking about, if earnings and revenue multiples don't work, are there other multiples that could reasonably be giving some indication of the value of a business? It could be, enterprise value relative to the number of subscribers, if you're in video streaming, for example. But again, also to think very carefully through, what will make these multiples actually more or less relevant, right? And you even there you see you need to get to the details of the business models, right? If you look at subscriber multiples for business like Spotify versus Netflix, we do need to keep somewhere in the back of our minds that Netflix is creating its own content, where Spotify is actually always paying third parties for the content, right? And that also has implications for whether the subscriber multiples are equally applicable and comparable across Spotify and Netflix, but also related again to the underlying business model. On the DCF approaches with the scenarios, of course, there's a lot to think about. How do you actually come up with good scenarios? How do you actually benchmark and project performance of businesses in the same sector even? That's where these things like the cohort analysis, where we'll have some examples of how to do that, the run rate analyses, and the attrition analyses are very important. And actually, I'm very happy to see that some of the stock exchange listed companies are actually providing information on cohorts, on different vintages of customers with repeat orders, etc. So it's a very good analysis that for some companies actually you can already do. And on the, let's call it technologically advanced analyses like real options and simulation to actually show in what particular cases they might bring additional insights, and where in most cases actually they might not be worth the additional effort and investment. So that's on, let's call it the cash flow and the corporate finance and the valuation aspects. And I think that's why this topic is so fascinating, because it actually is different ways of doing business with different underlying business economics, still very far out with a lot of uncertainty. And still, end of the day, you need to make an analysis that says, is this a high or low performing business? End of the day, you sometimes need to make a valuation that says, is it worthwhile for us to continue investing in this business, or should we invest in other businesses? Is this the time to sell the business, or what should this business be worth in the first place?
So definitely, it's a lot going on in there and a lot of different interesting topics. And I know that if there's one person who should be sitting at the front of the classroom talking about that, it's you. So Mark, thank you so much for taking time out of your afternoon and sharing with us your thoughts on digital business valuation. I know I learned a lot. Hopefully the same goes for those in the audience, who I'd also like to thank for joining us this afternoon. It's always a challenge. We sit oftentimes a lot behind screens these days, so we really appreciate you taking time to spend with us to learn a little bit more about digital business valuation. So with that, I'm Brandon Kirby. I'm with RSM. It was great to see you all, and have a wonderful afternoon, and we look forward to speaking with you soon. Thank you so much, everyone. Enjoy the rest of your days.
Thank you. Bye-bye.
Bye.